Welcome back to the TD Ameritrade Network. Let's talk a staple that might have trouble on the way. Let's bring in Ben Axler. He's the founder and chief investment officer at Spruce Capital Management to hear the bear case on Church and Dwight. And then we're going to do some trading here with Tom White in studio on it. Ben, good to have you back. So Church and Dwight is one of the few staples that shares have actually been climbing the past couple years. Is your bear case sort of a traditional channel problems, brick and mortar issues with old school products? Is there something more nefarious here?
Well, thank you again, Oliver, for having me on. Look, I think as you know with some of our shorts, it's a multi-pronged thesis, right? Mm-hmm. We look at the fundamentals, we look at the management, we look at the governance, we look at the accounting, and we try to develop a holistic view of what's going on. And in the case of Church and Dwight, we have some problems with the new management team. This team took over in 2016. They've changed course a little bit by doing slightly more aggressive acquisitions. We believe a lot of the legacy acquisitions, whether it be condoms, whether it be women's hair care, whether it be children's gummies, are just, suffering, right? I mean, they're in a lot of competitive categories. They operate, as they would say, in the land of giants against the P&Gs, the Cloroxes of the world. And they sell 20% plus through Amazon, which is just a brutal place to sell. And, it's evident in their margins that they're coming down. And so the new management has embarked on an even more aggressive acquisition strategy to fill the hole. We have a lot of problems with the recent acquisitions of Flawless Hair Care, which is a woman's razor, and Waterpik, which is an asset that's been shuffled around a few times that they paid $1 billion for. We don't think these are going to plug the hole. We think the stock's incredibly overvalued. We think insiders are selling. And we see tremendous amount of downside based on our normalized financials, which are materially lower than peers, and valuation compression as it becomes obvious that the Church of Dwight today is not the same as the Church of Dwight of 20 years ago.
Hey, it seems like you touched some kind of nerve in the company, because after being up for a long time, shares have been nothing but down since you started the report. So Ben, from the perspective of valuation, I hear you on that, right? It's quite expensive for a staple, trading at about 30 times even after the sell-off. But I look at some of the other metrics, and there's staples in the realm of like Dean Foods and Kraft that have had some really, really bad just fundamental numbers. For Church and Dwight, what jumps out to me is it's not as spectacularly, extravagant, even relative to some of its peers. Bloomberg's got it, yes, in the 70th percentile of valuation, but sales growth also in the 70th percentile, and EPS growth in the 70th percentile. What happens to those?
So, yes, we agree. We think the premium valuation is predicated on the perception that they're growing slightly faster than the overall industry. It's no surprise that the P&Gs of the world, the Reckitt's and the bigger guys are growing very low single digits. And with Church and Dwight, you're maybe getting, 2% incremental, growth. But you have to look at the quality of the growth, okay? A lot of our problems here is that they'll buy a company, it'll perform well for a year, if that, or two. And then what we're seeing is, revenue going down and the company reversing earnout liabilities and taking gains. And then, oh, by the way, management's getting credited bonuses for deal failures. But you have to look at the quality of the growth here. We think the quality is very low. We think the sustainability is low. And, we found evidence of, numbers not tying for acquisition contributions. We found undisclosed acquisitions, which we think management's using to goose the organic growth. And then lastly, I would say a lot of the recent organic growth was tied to price increases, which were just implemented to really offset commodity costs. So, what's going to happen in another 3 to 6 months when they have to lap those, one-time price increases? We don't think there's much pricing power in toothpaste or deodorant, to be quite frankly with you. So, it's the quality of the organic growth, it's the sustainability of the organic growth. I think that's what you really have to focus on here.
So this is interesting, Ben, and just to kind of recap for those keeping track here, it sounds like you found sort of some yellow to possibly red flags in terms of the fundamentals of kind of where the money has gone. But to the point about the products as well, is the company shifted from household to personal care, right? The percentage of the household products has come down a little bit over the past 5 years. The personal care has come up to about 34% of their revenue. It sounds like those are some of the products that you're saying, even if they were able to put a price hike on, because we talked about this when they did, it was a pretty big deal whether or not these staples could pass on price. Your point is that's not going to last, and what is going to be showing us that can't last? Just the way they distribute?
Yeah, so look, I think, if you look at their most recent products, right, they bought Waterpik, which is a dental floss company. The CEO was asked when they bought it, hey, what percentage of sales come from online? He didn't know the answer. I mean, I challenge everyone to go to Amazon, type in water flosser. You'll see dozens of competitive products there, some being endorsed by Amazon more than Church & Dwight's Waterpik. I mean, this is a slightly more discretionary product versus some of the more staple products that they've had in the past. The same thing with the women's hair care, the Flawless product, right? Why do we have concerns there? Well, it's an as seen on TV product that, quickly has moved from, the television medium. Now you can find it in the dollar store sitting next to light bulbs in the back of the store for $15 or $20. I mean, we pulled up Nielsen data. The Flawless products have traditionally shown a very rapid demand decline within, 2 years after introduction. So, you look at the quality of the products they bought recently, and it's quite poor. And a lot of these products are available online. There's cheaper competitors out there, and we just don't think they have much staying power.
Yeah. Ben, one last thing that I've heard you say elsewhere in interviews is that you've actually got an interesting position on here where you're short Church & Dwight, obviously, but you've also got a little bit of a hedge in another staple. Is that right? Tell me how you're managing the trade.
No, absolutely. Look, this is one of the easiest trades I've ever seen. I mean, the whole sector is pretty liquid. So you can hedge with an XLP, which is a consumer staple ETF. You can hedge, and we're hedged with some Clorox, which we think is cheaper, has much more dominant market share, whether it be in laundry detergent or kitty litter. You can see the products on the shelves, they pay a better dividend, it's cheaper. So yes, we're short Church & Dwight, we're long Clorox, we're long some XLP, and we think that Church & Dwight's going to underperform. We think the management has to come clean about the quality of the numbers. We think they need to address some of our points. I think it's worth mentioning here, they've refuted nothing we've said. You haven't seen a single analyst come out and pound the table to say, hey, you need to buy Church & Dwight on this 7 or 8% dip. No, because a lot of the analysts think it's worth less. I mean, you have analyst price targets out there from some of the big brokers in the 60s. So I think the way the management's reacting, the way the stock's reacting, the way the analysts reacting, it's all pointing to one way. It's pointing to down in Church & Dwight.
All right, there it is. Ben Axler, appreciate you joining us as always. We're going to do a little trading on it.
Thank you very much, Oliver. I apprioate it.
Thank you, Ben. We're going to follow Ben's lead here. All right, so you want to get short. How do you do it with options, Tom? Tell me.
Oh, in Church & Dwight, CHD, the stock's still up about 10% in the year, but down about 10% from those highs post-earnings. Options, it doesn't have weekly options.
Okay.
It's only got September, October, and then all the way to January.
Okay.
So you got to be a little bit nimble with this one. But because
big options liquidity.
Yeah, volatility hasn't popped in this name because they just reported earnings a few weeks ago. But what I looked at was a simple put vertical down here, and I made it a little bit wider than I normally would. Buying the October series, you got about 38 days until expiration on this one, Oliver. Buying the 75 puts, which are in the money, by about $3, and then selling the 65 puts. I roughly put a $2.50 debit on that. With the stock pulling back this morning from before when I came on air, it's up probably over a little bit over $3, but I still like the setup. If you are bearish on this name, you're paying roughly $250. Your potential rewards about $750 on that trade. So what you're looking at there is a break even of 72.5 if you can pay $250, and the stock's already below there. So it starts to ramp up immediately. You've got about a month in this trade. Now, if you want to do something a little bit more long term for this to play out, what our guest was talking about, that pullback in Church & Dwight over a longer time period until the January expiration, you can go out and buy that same put spread and pay roughly about $4 for that. So you still have a favorable risk reward, paying $4 with $6 potential reward if it goes below 65 at January expiration.
Okay.
But this is how I would play it if you were bearish on that name, just because volatility hasn't expanded. And if you continue to see a slide in this name, it's not going to get protected by the analyst
Even
community.
with the sell-off, vols haven't spiked in a major way?
No, because they just had earnings recently a couple weeks ago. So vol's still relatively low on a historical basis when you've seen a 10, 11% pullback in the shares over the last couple weeks.
Ben's also long Clorox, or he said XLP. You could do a lot of different ways. What if you think about the Clorox side of this?
Well, I looked at Clorox, and it's down in with a lot of the other staples. PG's pulled back a little bit too, but Clorox I looked at just a call vertical or call calendar to the upside using the 160 strike. The shares are just below 160, around 156, 157. And you buy in the October series, so about 38 days until expiration, selling the near-term Septembers that expire in about a week and a half. You're paying roughly about $1.90 debit for that. But Oliver, you see right there where the apex of this trade is, at that 160 strike that you're doing the calendar on. It's one month wide, and you've got a range of about 155 to about 165 for the shares of Clorox to trade within. So you could be wrong on this directionally, where Clorox pulls back to 155 and is still potentially profitable because of that range that you have in this particular trade. And if the stock does pull back, volatility will go higher. Long calendars are a long vega or long volatility strategy. So if volatility expands, the price of that calendar will expand or at least offset that move away from the ideal 160 strike.
Yeah.